Hello, everyone, and welcome to episode 2 of our series on riding out the economic downturn with mutual funds. I'm joined today by two very eminent panelists. We have Maneesh Dangi, who is CIO of Fixed Income at Aditya Birla Sun Life Mutual Fund. Welcome, Manish. And we have Deepak Shenoy, who is founder and CEO of Capitalmind.
Hi.
Hi, Deepak.
I'm
So, fixed income is at a very interesting juncture right now. On the one hand, we have low rates and rates falling further in banks and also in debt markets. So that's squeezing savers. On the other hand, there are credit issues in some debt funds. And so although some of those funds have high yields, there is that enormous risk there. So how does an investor navigate these two big issues? That's something that our panelists will shed some light on, along with many other issues in the debt space. So, Manish, if we can begin at a very basic level, what are debt funds and how do they compare with bank FDs?
Debt funds, from the point of view of what they do, of course, is that they lend. Okay, in a sense, they lend to corporate, they lend to government, they lend to state governments, and private and PSU. So this is what they do. But from the point of view of an investor, as to what investor experiences is another name for debt fund is fixed income fund. It gives you an experience of a fixed income or fixed deposit like returns, or very close to that. They are not fixed deposit. They're not really fixed. But if you can allocate your capital for a reasonable time in these debt funds, you're very likely most of the times to sort of get a fixed income kind or fixed deposit like returns. So that's how I would define debt funds for a retail investor. Its experience is very close to what your friendly neighborhood bank gives.
Right. Deepak, so how does the comparison stack up? Is it even a fair comparison?
the concept of a fixed deposit is like this. You give a bank your money, the bank owes you money back. Then the bank takes the money and lends it to other people, and then those other people owe the bank back. If they don't pay the bank, the people that the bank has lent to, then the bank first takes the hit. The depositors come a lot later, right? So in the sense that even if a lender, if a borrower of the bank has defaulted, it doesn't mean that your FD will not come back or you'll have a lesser return on your income on your deposit. It's kind of fixed deposit in that sense, and there's a backstop as well. So there's a backstop by the RBI which says I'll be the lender of last resort in case you need something. There's also a 5 lakh rupee insurance on every bank account. So effectively that adds another layer of security. These securities. This security in this insurance, if you may, does not exist with a mutual fund. In the mutual fund, you are the bank. You're giving your money to a mutual fund manager. The manager on your behalf is lending to a bunch of organizations. And those organizations could be the government, which are government securities, or they could be corporate, in which case they're corporate debt securities, and a bunch of others. They could be state loans and so on. So now you are the bank, in the sense if one of them doesn't pay back, the mutual fund manager will not say, listen, I will take the hit. They will say, listen, there's a problem, this guy hasn't paid back, and therefore you have lost your 1% or 1.5% because I've spread your investment across 100 people, one of them hasn't repaid. Typically, like banks have NPAs, you will have an NPA once in a while, but you don't have the same security as you do in a bank. There's no insurance. And for that, you will get paid a slightly higher amount, usually. And that is the difference. In the case of a fixed deposit, you have these other security backstops. In the mutual fund, you don't, but you're doing the same thing, effectively lending. In one case, you're lending to a bank. In another case, you're lending to a lot of corporates through a mutual fund.
There are, of course, the tax advantages and the liquidity advantages. So mutual funds are, in case of capital gains, for mutual funds held more than 3 years, the tax is 20% and you get the benefit of indexation. And you can redeem your money at any point of time. Unlike with FDs, where if you break it, then you pay a penalty and so on. But one interesting angle has come into this very recently. In fact, it will go into effect tomorrow itself, which is the new stamp duty. So can you tell us a little bit about that? Does this change the picture at all?
So I think the duty is 500 rupees per crore and 1,500 if it's a demat transfer. This can, there are complicated things over here. I don't know the exact details so far, but it will hurt people who are doing like overnight investing. So, for instance, anything invested overnight is a complete waste of time. The same thing on the other side will be a 3-day or 4-day investing for individuals will probably have no returns. So in that context, where we used to talk about FDs not being available for 7 days or 10 days, it now becomes a little bit more inconvenient to use a mutual fund for an overnight or liquid fund kind of thing for a very short duration. But otherwise, if you invested for a longer term, I don't think this is going to be a significant problem. I also believe that the numbers are very high right now. 500 rupees a crore, extremely high. It will reduce a lot of volumes in mutual funds, in the overnight mutual funds and liquid funds. And these are also quite substantial. I think we're talking about 80,000-90,000 crores in one liquid fund. So you see, so I think that will have to be addressed by at some point lower rates. But I hope this does not create a lot of risk. I don't think it's a big problem for retail investors who are investing for the longer term. It's a very tiny amount.
So what I read in a couple of research notes this morning is that the longer you hold the debt fund, the lower is the effect of this stamp duty. So typically, if you hold it for 3 months or 6 months, then it becomes a very, very, very negligible effect. But Maneesh, can you elaborate more on what this duty is and what kind of effects it will have on debt funds?
I mean, any transaction that you do, you ought to pay to state government, but your mutual funds in the demat form, when you are acquiring, selling, there wasn't the stamp duty. Now it's applicable to mutual fund as well. Its effects are for investors outside of the overnight fund and maybe to a certain extent liquid fund is insignificant. For an overnight fund, typically about half the money that we were getting, was actually exiting every day. Now there is a significant loss out there, because you were earning about 3% returns for a day, and if you move out after a day, you're losing 1.8%. So you're left with just 1.2% return. So therefore, I think a lot of this money will have to look for something else, and which is perhaps liquid fund, which are in any case far better products than overnight fund. They don't run the kind of risk, but given the general risk-off environment that we've seen, a lot of investors, especially the institutional ones, have actually migrated to overnight funds.
So now let's turn to credit risk, which has dominated the headlines for the past several months, in fact years, since the September 2018 IL&FS default. So Maneesh, can you tell us exactly what has happened in this space?
What has happened in the credit space, basically, look, every couple of years, perhaps every decade, something like this happens when certain corporates actually borrow more than what they should have, okay, or their balance sheets allow themselves to borrow, or the business prospects of the stuff that they invested in actually turned out to be weaker than what they had imagined. Then of course they don't have a choice, eventually they default. So it's a typical business cycle, boom bust cycle, which happens every few years. If I were to sort of survey last 30 years, banks have had 4 sort of major credit crises. And in every crisis, banks, and I'm talking of banks right now, and I'll just get to mutual fund, but banks ended up losing 5 to 20% of who they lend to. Okay, so when I say 5 to 20%, meaning of the total credit portfolio they had, okay, 15-20% of those portfolios turned NPA. Now they're not losses. Okay, effectively, these borrowers stop servicing the interest or principal payment to these banks, and then some kind of a restructuring happens. Sometimes these losses fructify, some of them are recovered, and so on and so forth. Okay, so that's the context of a credit crisis. That it's a 4th credit crisis that we've been going through in last 5 years, since 2015. Okay. Now, mutual fund also got trapped into it to a certain extent, because mutual fund also in the end lend. Now, the tragedy which has happened in last couple of years in India is that all the large borrowers who sort of borrow money, let's say if you had borrowed more than 100 crores in India any time in last 5-7 years, okay, the probability that you are not able to repay is almost 15-17%. So 15 to 17% of the top of 100 crore plus borrowers, okay, which are not many actually in India, have actually defaulted in last 5 years. Okay, mutual funds actually lend to these 300-400 corporates who actually borrow more than, invariably more than 1,000 crore. So if you had borrowed more than 1,000 crore in India, almost 8 to 10% of that borrowing actually is in default right now. We are in the midst of a big credit crisis in last couple of years. Mutual fund also got trapped into it because we also lend to more or less the same corporate that banks lend to. The good news, of course, is that of the 12-13 lakh crore of a fixed income mutual fund industry, the total amount that would have gotten into stress, where the multiple downgrades would have happened, or these firms, franchises had come close to default, would not be more than 1.5% of the total AUM. Okay, and the total amount of losses for mutual fund would be sharply lower than 1%. The gross NPA equivalent, if we were to see for mutual fund, it will be sharply lower than 1%. And the loss given default, because you are able to recover a lot of money from a lot of these defaulted assets, will be 70-80 basis point spread across 3 years.
If I could draw a counterpoint there, a lot of mutual fund AUM sits in liquid funds and overnight funds, which by definition put money in low risk debt, and that skews the statistics. So if you maybe isolate certain categories, you will see that the NPA equivalent of mutual funds is much higher.
No, it's not. Even in a credit fund industry, the credit fund industry, credit-oriented fund would be, let's say, 2.5 years ago, when the credit started to boil, was about, let's say, 1,40,000-50,000 crore. Okay, the total losses to the credit funds would be about 5,000-6,000 crore. Okay, so 5,000-6,000 crore on 150,000 crore is about 4% spread across 3 years. Because some of it materialized in 2018, then 19, and then now in 20. So it's about 1.5% annualized losses. Gross NPA, I would call it. Okay, gross NPA is about 4% for a credit fund industry, and the losses would be lower. If you annualize them, then it's going to be about 1.5%. So even for the credit fund industry, it wouldn't be as substantial as one would imagine. It's been a lot higher for even private sector banks. Let's say the gold standard private sector banks would have written off about 5% in last 5 years. I think something like HDFC Bank would have written off about 5.5% in last 5 years, and we'll have a gross NPA. A good bank a very good private sector banks will have a gross NPA of about 2.5%. So the total NPA, which is gross NPA plus write-offs, is about 7%.
Sure, Maneesh, I take your point, but Deepak, if you look at the effect of a default or a downgrade on investor psychology, so typically there is a cycle where a downgrade is announced, then withdrawal starts, so the exposure to that paper keeps increasing, and it's a vicious cycle. Then when the actual default happens, it's a much bigger impact than what the fund had originally bought. So a bad paper that was maybe 1% earlier becomes 5, 6, 10%. So given this problem, because with the structure of debt funds, when confronted with default, what really is the solution? Is it better communication? Is it more stringent credit assessment? What's the solution?
So this is a very. I think I don't have perfect solutions. I don't know if I'm the authority for them, but I think we've all kind of started to see where the problem is quite serious, right? So it's like, I give an example of, if I have 10 eggs, and one of them is broken. My broken egg percentage is 10%. But if you come to me and you're my investor and you tell me I want 5 eggs, and you're not going to accept the broken egg, I'll have 5 eggs left, out of which one is broken. So I have 20% bad eggs. So that means my bad assets keep going up. Now, the way it works in mutual funds is that once the whiff comes of a default, the mutual fund scheme can identify the problem. what can it do about it? It can't go to the market and sell that debt because in India, the vulture debt industry is relatively small and almost non-existent for the most part. So the mutual funds are on their own. They're not going to get a buyer on the other side. So if you go to the mutual fund and say, I want my money back, the mutual fund has to say, listen, I can't sell this stuff. So let me sell the stuff that actually sells, which is the good stuff. And then you get your money back. Now, typically the first people to get a whiff of this is somebody who knows. So there's always asymmetric information. The more informed investor may want to take his money out first. The less informed one is suddenly left with the bag, say 2 weeks later, and then the complaints start flowing in saying, why didn't you tell us? Should there have been more communication? But I think at this point, you have to understand the structural problem of liquidity. You're giving liquidity on an on-demand basis, but you can't get liquidity from anywhere. So as a mutual fund. So I don't know how to solve this other than the mutual fund industry actually saying, listen, we need to be able to bar redemptions in this case. SEBI has taken an intermediate view that says on 24 hours after a downgrade, you are allowed to segregate the fund. The downgrade happens a few days after everybody knows there's a problem. First the intelligent people know, or the informed people know there's a problem. Then the uninformed get to know there's a problem. Then the rating agency downgrades. By which time,
like the Indian police,
so they've taken out their money. Whoever is panicked or whatever, the mutual fund is now saying, listen, we know the problem. We can't do anything to solve it, and you're not allowing us to bar redemptions. And the reason they don't allow them to bar redemptions, the SEBI feels that, then mutual funds will just bar redemptions all the time. But I don't think that's in mutual funds' favor. No? If you bar redemptions once, you're not going to get more investment. So
Manish, can I take that to you? Manish, can I take that to you? Is that one answer to bar redemptions?
No, in a sense, okay. We'll have to distinguish funds which sort of dial credit risk, and there we'll have to build a structure in which the T+1 mechanism of withdrawing money, meaning today you want money out and tomorrow you get it, that will have to be revisited. So in a sense, right now there is an asymmetry that Deepak pointed out, that the markets don't offer the size of liquidity that we promise to our investors, especially in the low grade bonds. Okay, they're not liquid, and the bid ask is very wide if we turn out to be desperate sellers. Okay, so therefore it'll be wise, if we evolve a framework for the credit fund, particularly for the credit fund, that we do not have a T+1 withdrawal mechanism. So let's say hypothetically, I wrote a memo a couple of weeks ago, and I made this point that let's say if you want to withdraw money, then you have, let's say, put in about 1 crore rupees in a credit fund. Then perhaps we will give you 10 lakh rupees a day out, and then we sort of space it out, in 5 days, 10 days, 15 days time. So I think this kind of mechanism does exist in West, particularly in US, and I think once this crisis gets over, we will have to sort of engage with our regulator and ensure that we gate these investors rather the redemptions in a manner.
So it's a partial gate you're thinking of, not a complete stoppage.
I mean, of course, you need some amount. See, basically, when you are investing in a credit fund, what are you getting in? You're getting in a fund which is in long periods of time earn about, let's say, 2% more than typical AAA centric fixed income fund for the same expenses. So there is a compensation, but then there is a risk out there, which is credit risk. Now, what Deepak pointed out, that when it materializes, everyone wants to run, and there is a group think here. So when the risk is materializing is the precise time when I want everyone to stay with me. Otherwise, our situation for the residual investor, would continue to deteriorate. Okay. And unnecessarily, when investors run, some of them are running for reasons that possibly is not right reason. While it is true that some smart investors run because they are well informed, but I have to tell you, being an insider, that there is a large majority of investors who run for the fear of unknown. So what had happened, what played out in April, May, Were those wise investors who moved out? The answer is no. They were fearful that another Franklin would play out. They were fearful that massive losses will fructify in their funds, and which is why they ran. Now, in hindsight, it was a wrong call by investors, because some of them because in our funds also when they ran, we realized that a lot of them ran without completing 3 years. So massive losses there.
If I could interject, the jury is still out on that, right? In fact, Deepak, if I can take that to you, the latest reports on banks show that around 30% of the loan book of the major banks is under moratorium. Because that doesn't mean NPA, but it's certainly a signal. And there are a lot of kind of postponements by RBI, SEBI saying that because COVID is happening, so reporting gets relaxed and so on. So the picture is very opaque right now. Kind of looking blast into the future. How do you see this panning out?
So, if you look at debt markets per se, there is now clear dichotomy between people who can borrow and people who can't. People who can borrow are getting money at ridiculously low interest rates. This is partly because RBI has cut credit and increased the amount of money that's been available in general, but also because they've created some schemes. So, for instance, they started with this LTRO, which was about them buying bonds and them funding banks to buy bonds in secondary and primary markets. That's increased the liquidity available to certain corporates. It's also created another scheme for mutual funds that wasn't as quite successful as the original LTRO, but that also adds another layer of comfort. Or I don't know if it's still valid, but I think what has happened really is that liquidity has kind of helped some of the big borrowers raise money for their liquidity needs. Mutual funds will not see any problem right now because there is no liquidity problem per se for the large corporates. There may be some for smaller ones. There are, of course, downstream issues. So once these NPAs start to trickle in and the moratoriums go away, what happens? Because a downgrade will then mean that a downgrade now creates almost a binary thing for a mutual fund, right? So you can't, for instance, if 5% of my money is given to, say, a company X, and that company X after moratorium defaults on some obligation because it can't make up its return. The bank now has the facility to say, look, for 3 months, I won't call you an NPA and try to work and negotiate with you. After 3 months, as an NPA, I will allocate only 15% as provisions.
Yeah.
It still work with you. The mutual fund doesn't get all that. It gets a downgrade. The minute it gets a downgrade, everybody hears about it. Twitter, Facebook, everything. Oh, let's get out this fund as 5%. The fund has now no option to say, listen, he owed me 100 crores. I'll call it like he owes me 75 crores. So taking a 25% provision. You can't do that because when people start exiting, they'll expect that 75 crore part of whatever you've lent to this corporate to also be part of their redemption. So mutual fund now will mark it down to zero or segregate it in a way so that you can't redeem that part of the fund. This creates more consternation, more redemptions happen in funds that don't even own this security. It's saying that so this is the thing that we should actually try to reduce and try to diffuse in the sense you can't have panic selling without any liquidity backstop to the mutual funds of any sort. And then assume that the system will perform and then interest rates to corporates will come down because we have to reduce interest rates. So I think at this point we do have a problem, but this problem is more exaggerated for mutual funds because they don't get those little leeways that other lenders do.
Sure. And as you pointed out, in case of a bank, the credit risk is taken by the bank, not by the depositor, whereas here you're taking the credit risk.
No, I'll provoke both Neil and Deepak here right now. While it is evident that mutual funds offer better liquidity and arguably better returns if you stay invested for longer term, I would actually argue that they're far better instruments than banks, even in terms of safety. Now, I'll tell you why. Imagine, first of all, invariably, when you invest in a bank, fixed deposit, you don't diversify. You typically pick one good bank your dad had, or your company has given you a salary account, and you invest pretty much all your money there. Okay. Now, you might think right now that, your money is safe in bank, up to 5 lakhs, of course, there is a deposit insurance. But then do not forget that, that this is also a part of cycle, that many banks go down over and over again. Okay. It's just that it's not happened in last couple of years. The PSU banks have not gone down because they're government owned. But you know what happened to Yes Bank. Had they not been bailed out,
And PMC
because
Bank
PNC did not get bailed out, your money is stuck there. Many hundreds of cooperative banks have shut down. Okay, your friends and relatives had actually invested there thinking the same thing. So basically, what even the worst experience in a mutual fund, because of the sheer fact that the funds are allocated across hundreds of securities, tens of banks, they are far more diversified, and therefore the black swans don't play out in the form that they play out for bank. Similarly, let's say fixed income or debt funds also are risky. But in equity, it materializes more often, and which is why equity its risk appears exaggerated versus fixed income. And banks' risk appears underappreciated just because there's a small layer of what you call insurance there, because there's small capital. Now, Deepak talked about capital. How much capital a bank has? The tier one capital of many banks is 6-7%. You're looking at a COVID situation where Deepak seems to think that 30% of the banks have portfolios are moratorium. What if 5% or 7% of that actually materializes in terms of losses? Then would you not lose money? It gives an impression of safety because it behaves for very, very long time of a very safe instrument, and suddenly it collapses. Okay, so my advice to investors is that instead of dialing bank, even for safety, mutual funds, fixed income mutual funds are actually far better in terms of safety profile than banks.
Yeah, that's a fair point. Yeah.
Personally, I would agree with Maneesh in the sense that my choice of instrument would still be mutual funds. I mean, don't get me wrong that it's not, it's not acceptable. I'm just more cognizant of the risk. So if you tell me that tomorrow one of my investments, the debt mutual fund fell 2%, I'm like, that's part of the game. It's fine. If there's a risk involved, even in the risky things that people called risky, Vodafone Ideas payment, which caused a certain set of funds to have segregated it in January, right? So people said, oh my God, my fund lost money. Guess what? Come June 12th, they have paid their interest. Come June 25th, they might actually pay the principal back. You might not even have seen the risk if you're a long-term investor into these 6 months might seem like a long time right now, but come 10 years, you might look at this and say that was only 6 months that my money was stuck. So it's not necessarily that the risk is, it's not necessary to say that just because there's risk, it's a bad instrument. And like Maneesh clearly said, a lot of our banks are terribly undercapitalized. You and I are paying that tax, which will eventually capitalize some of these banks more. But we know that they're terribly undercapitalized. They called PSU bank, so we kind of say, okay, nothing can happen. There's nothing like nothing can happen, because still Lehman, a large investment bank in the US, also had not failed. And suddenly, people saw it fail and all magnificent things happen. So I think I have to clearly say that while the risk is there, it's not like mutual funds are bad. It's still very tax efficient. The good thing is you can choose your risk, right? So you go through a gilt fund if you don't like risk. If you understand credit funds, go.
Yeah, Deepak, if I can pick up on that, on the gilt fund story. So a lot of these long dated funds, gilt for our viewers is government bond, and they tend to have long maturity papers, 7-10 years and so on. They have delivered fantastic returns over the past year, double digits. So Deepak, what's the issue there? Why not just invest in those kind of funds?
So my view on this is a macro call. This is not really a fund level call. You're not really taking a big manager bet here. You're taking a bet on the particular instrument that's underlying the fund, right? So it's more like saying the manager will choose which maturity funds to pick. But beyond that, I want to know that I'm going to be in government bonds. Now, the macro call here has to be based on a certain understanding of the situation. So they've done well in the last year, and the reason for that is that interest rates have fallen. Interest rates continue, according to RBI, to be in a state where they're saying, listen, we're not likely to raise rates. We're more likely to keep them stable, or they might fall further. The US has seen rates fall. Most of the Western economies have rates fall. So we're not getting competitive pressure from other countries either. So there is currently no real pressure to raise rates. There is a problem in inflation. It could surface. If inflation surfaces, rates will go up. If rates go up, you will lose money in gilt funds. And that has to be the criteria that you have to use to say, I want to be in gilt funds or not. Not because of their past returns. Everything about macro, the past matters very little, the future matters a lot more. And you get some visibility into the future because the people who control these interest rate situations.
Sure. So Manish, what is your macro call? And the RBI has announced LTRO quite recently. So could you explain what this is, and is that a reason to buy gilt funds or long duration funds?
I mean, see, interest rates are likely to stay depressed for very long time because the growth conditions are very weak right now. And it is likely that we will have low rates for very long. But the rates have fallen a lot. This big bull market, which arguably began in 2012 or 2014, depending upon the date that you pick, from 9% on a 10-year bond, it's fallen to 575. Interest rates have already rallied a lot. Now, it is possible that interest rates will fall further, but the space is now limited, at least for the longer bond, because the balancing act of higher fiscal deficit, huge amount of paper supply, would actually ensure that the term premiums stay elevated. And therefore, the space for the bonds to rally meaningfully now is lower. So all your investing decisions are blend of two things. One, of course, is your asset allocation, which is that what percentage of your portfolio should be invested in equity, fixed income, within fixed income, credit, gilt, and so on and so forth. And two is your macro call. Now, there is always a space for a gilt fund because it balances the equity risk. Okay, when a large amount of credit risk or an equity risk materializes, gilt fund actually does the opposite, and therefore it somewhat neutralizes the losses that you have from these relatively riskier products. Okay, so to that extent, gilt has its place in your asset. But from a macro standpoint, you have to take calls of being overweight or underweight in asset class. I think broadly speaking, I would argue that over next few years, gilts returns would be depressed. It is possible that in near term they will do well, but then last 10 years, gilts have been the best assets. Okay, in last 10 years, our gilt fund would have returned about 9.5%. Arguably better than most equity funds. Okay, but looking at that, one shouldn't dial gilt funds right now because, in my view, this current reflation trade which is playing out would ensure that equities would most probably outperform pretty much all asset classes, and gilt returns would be somewhat depressed over the next 5-10 years.
Sure, but considering what the RBI is doing, that they are buying long-dated bonds and selling short-dated bonds to flatten the curve, does that provide an extra kicker to gilt fund investors?
Yeah. So these are technicalities. I mean, right now the spreads are the term spreads are high, and of course in RBI's view and all markets view also, it is potentially obstructing the economic recovery. And which is why it's necessary that we bring down the term premia. Now, why term premias are high? Because, left to themselves, markets are overwhelmed by the government bond supply right now. We don't have the kind of savings, to sort of ensure that we absorb the kind of government bond and the state loan supply, which is there right now in the system. So, which is why in the hyperactive RBI policy or the Fed policies, they're all trying to depress the long end. Fed has been doing it by active QE. India also did a lot of QE in Jan, Feb, March, April. And now, given that system is already extraordinarily surplus in terms of liquidity, the instrument that is being used right now is Operation Twist. So that they're buying the long end and supplying the short end, so that it's net neutral in terms of liquidity, but actually depressing the long end of the curve and reducing the term spread. So these would actually make sure that, term spreads don't widen dramatically, but the space for the term spreads to sort of narrow dramatically is also quite shallow. Also, please understand that on an average, India's 10-year bond trades at more like 7%. Okay, for our macro, our demographics, our kind of inflation profile. Right now, we are at 5.75. You could potentially go to 5.5 or 5.25, but it would if you're a 3-year investor, which you should be in a debt fund, it's very likely that 3 year outs, interest rates will be higher from where we are right now versus lower. So therefore, I won't like you to sort of buy extraordinary term in your portfolio, 10-year or 15-year. It's better that you sort of stay in corporate bond fund, banking, PSU, short-term fund, and such like right now.
Sure. So one solution to this issue of interest rate risk is what are called target maturity funds, where you buy the fund and it's simply the maturity of the fund decreases as it kind of heads towards its target maturity. So Deepak, what is this concept and does it solve that problem?
Oh, well, I think mostly we've had two kinds of such funds. One is the FMP, which is your fixed maturity plan. You buy it once, you can't buy it after that. It's going to buy bonds that are going to mature in that time frame. And even if something matures in the middle, they can only buy something that will mature in whatever is left. So you can't say, I'll buy a 3-year bond now and then 3 years later buy another 3-year bond. You'll have to buy like a 6-month bond to make the 3.5-year profile. These are very tax efficient in the sense they straddle 4 financial years. So you get 4 years of indexation. The way this works is that you roll it, since you're rolling down, in the sense every time there's a interest payment, you get some money. You're not going to use that money to buy long range bonds. You're going to buy bonds only that mature in that profile. You remove the interest rate risk almost completely. In the sense, whatever interest rate risk you locked in, it's there. There's maybe credit risk. We saw that in the Z issue in some fixed maturity plans.
Yeah.
But other than that, you're kind of okay with the interest rate risk for those 3 years. You're locked in. There's liquidity risk. You can't get out before 3 years. But since you're fine with that, and you understood that when you got in, that's fine. And that's a good way for one structure to work. The other one is the ETF that we've seen recently, the Bharat bond, the concept of 3 or 10 years in an ETF format. You can only buy it on the exchange. You can sell it on the exchange, but you're not actually selling back to the fund. You're selling to another person who wants to buy it. And therefore, that fund itself reveals its portfolio. It tells you there are 3 years left to maturity. So we're going to only buy bonds of certain types, which will mature before 2023 or 2030 or whatever it may be. These are interesting funds to reduce, again, interest rate risk. But in the second option, since you got liquidity, the liquidity option allows you to exit at any time. And in the process of exiting, you may incur a loss. That loss can be substantial if interest rates go up in the interim. So right now, for instance, if RBI came out and said, listen, we're increasing interest rates, inflation is too high, they increase interest rates from what is currently 4% to say 5.5%. Bond yields also go up substantially to 8.5% from where they are right now, which is 6.5%. Those additional 2% increase in the yield is a roughly 14 to 15% loss on the bond prices. So what you might have made as a 6% interest rate in 1 year, you lost 14% on the principal effectively. So you've lost 9%. You could choose to exit that in the market and say, listen, I've lost money in a debt fund. But it's not really a loss in the sense, it's a loss for you, of course. But if you had stayed the course, you might have not lost that 14%. Now, I'm giving numbers. I don't know the exact calculations. The actual numbers will be lower for 2023 versus 2030, but I'm just giving you that example. These are interesting products for people who can afford to say, I don't want to see my money until the rest of that time frame. But it's possibly the risks have to be enumerated in that context, that there is a credit risk in there.
Sure. So basically, Maneesh, it's a very elegant concept, right? The yield to maturity is, let's say, 7%. I know that I will get, let's say 6.8 because there's some expense ratio, so 6.8%. If I hold this fund to maturity, which is whatever, 7-10 years, I don't have to deal with interest rate risk. I don't have to deal with possibly even credit risk. Is this a good structure, or it's not catching on much in the market? There's issues with it.
No, it's caught on, and in a sense, its promise of fixed-ish return actually is why it's been fancied by so many investors. But fixed maturity plan that Deepak alluded to has been in existence and is fairly big as a percentage. I mean, it's relatively small as a percentage of overall AUM right now because absolute levels yields have fallen, but FMPs have been there. Now, what's the new construct of these roll down maturities? Okay, there is only one problem in it, that as initially in the first 15 minutes, we discussed that the chief risk in the mutual fund space is liquidity. Okay, and the fear that someone else may get a better information and exit ahead of you. Okay, and therefore, given that liquidity is not there, eventually the ones who stay put actually are relatively worse off, is what people think. And that itself perversely leads to a group exits. Okay, and a lot of people start to move out. FMP solves that problem because it's close-ended. So once you come in, okay, as a matter of fact, the construct of the fund, that, no one can outsmart you. Okay, everyone is at par, and then you are invested for 3 years, 5 years, 10 years, and no liquidity problem to be solved. In fixed maturity plan, you can't run ALM mismatch, so you can't buy a 4-year paper for a 3-year security. Okay, so fixed maturity plan is an extraordinarily elegant plan, and it does a good job of actually comparing itself with fixed deposit with much better diversification. But the big cost to pay is liquidity. Now, what fund houses have tried to solve the liquidity problem of fixed maturity plan by opening up the open-ended platforms and offering the same thing. So you give a fixed maturity plan on open platform, but then as they say that, then you're losing on to something, which is that the fixedness of the instruments and the structure. It is evolving. You're running ALM there, and then meaning there sometimes you're buying a 4-year paper in a 3-year plan, or you're buying a 2-year in a 3-year plan. So you're running an asset liability mismatch. And 2, you're not solving for a potentiality that someday suddenly some smart investors would like to exit, and suddenly the markets won't offer you that kind of liquidity. So therefore, my advice to investor is that it is better we also offer these roll down products, by the way. But in general, I would advise that if you really want a fixed maturity plan kind of return profile, I think FMPs are better instrument to solve your problem than these roll down funds.
Okay, so we're running out of time, gentlemen. Let me conclude with the question that I began with, that the Indian mutual fund investor today is confronted with this duality. On the one hand, yields are down for what are considered safe mutual funds. Bank FD rates are down, so you're either stuck with 5% or 4%, or you take credit risk and you don't know how much will default. So how do you draw that fine line and kind of get the most yield for the lowest risk? So Maneesh, if I can start with you.
I mean, a very, very big macro answer is diversify. Okay, don't, just because some credit risk has materialized, your what do you call it, innate idea would be to sort of drive away yourself and your friends and relatives to something that does not have any risk whatsoever. And invariably, you would dial funds like banking PSU or liquid funds or overnight funds, which will depress your returns. Okay, so I think the key here is to always, across mutual funds, across fund structures, in the fixed income also diversify. Look, in a 12 lakh crore of fixed income industry, the credit fund is about 30-40,000 crore. So 3-4%. So at an industry level, just 3-4% is invested in credit fund. So you, Neil, as an investor, should potentially look at investing 5% perhaps in credit fund, and then about 50-60% in various short dated funds like short-term fund, corporate bond fund, banking PSU, and then rest could be in, some of it could be in income fund, about 5-10%, and whatever sort of your routine needs are there could be in liquid funds, 20-25%. But diversify across,
Sure, Deepak.
So my view is, I think debt funds have complications and complexities involved, and I think an investor that wants to go a little bit deeper should actually look at a number of factors. We did a webinar of sorts recently where we talked about this in quite some detail, where we talked about how to look at individual portfolios of mutual funds. What do they actually tell you? How do they reveal what they tell you? And whether you're comfortable having that risk on your books. So you're a banker, right? So you're effectively going to be lending that money. The mutual fund manager is the manager. You're just trying to find out what he's invested in. And I think going through those portfolios is not an easy process sometimes. It's important to understand what they are. And there are some elements that are red flags, which may not be red flags for a mutual fund person who knows what's happening, but maybe a red flag for you. For instance, after the Yes Bank fiasco, we've had 81 bonds going to zero. A lot of mutual funds also, some mutual funds lost some money there, but we know that now if there are other 81 bonds of other banks potentially that could have a problem, and they're in the mutual funds that you own or you want to own, you're aware that that risk exists when you see them. I think it's important for someone to build a portfolio based on how much risk they're willing to take. When you go into a realm of taking too much risk, you might as well shift into equity. Debt to a large portion is a comfort feeling, right? So people want to just see income or see it as a curve, straight to the right and without any changes. If that is your objective, you've got to choose the kind of fund that gives you that kind of structure, or a portfolio that gives you that kind of structure. So if you're going to get unduly worried that, oh my God, this thing is defaulted, it's there in two of my mutual funds, what do I do now? Don't do stuff that makes you worry at night. So cut down that risk. If you can't handle it, then don't take that risk. I mean, that means either stay in liquid funds or really short-term funds that take very low risk. There are liquid funds that buy only government bonds. You could literally buy those. I mean, very little returns, 3.5% a year. But that's your risk. There's RBI bonds, which pay 7%, 7.1%. There was a release recently that give you no liquidity for 7 years. You can't touch your money for 7 years. You just get the interest. You want no risk, take that. If you want something in the middle, admit that you'll have to take some risk and you'll have to study a little more on what your funds own. And like Maneesh said, diversify across funds. I won't, of course, take a view of saying buy 15 or 16 funds, but have parts of your credit in something that's shorter term in nature, parts of your credit is something longer term in nature. And based on your comfort, you might want to increase the amounts on one side, whereas reduce on the other side. My view is it's always going to be personal, in the sense your credit risk profile is very different from someone else's credit risk profile. So once you find out who you are and whether you want to take risk or not, or whether you can handle the risk or not, then choose the kind of portfolio that's appropriate for you. Usually we have found that when markets are doing well, people want to be aggressive. When things look risky, everybody becomes a conservative investor. So the more cycles an investor has been through, the more likely he is to know what kind of investor he is. Otherwise, you have to assume by default that this person in the face of risk will panic. So using that as a benchmark, I think everybody should construct a portfolio that contains at least some part of really short-term, low-risk products, and a portion of longer duration, longer term to maturity products, which again are based on this conservative aggressive profile, where you can choose maybe credit risk. And I wouldn't advise credit risk in any case, but I think corporate bond profiles are better, or gilts are better in that.
Sure. All right. I think that then is the key learning for all of you who are watching. First, as Maneesh said, diversify. Second, know yourself, know what kind of credit risk profile you have, as Deepak mentioned. And more than anything else, ultimately, figure out the mechanics, understand what you're investing in. And I hope that today we've been able to take you some way in that direction. So thank you very much to both my panelists for joining us. And thank you, viewers, for watching.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.